Bismillah, Assalamu alaikum. Welcome to another tutorial. In today's lesson, we'll go through some of the important concepts related to the floating exchange rate system. So, now before we obviously start with the floating exchange rate system, we need to get an idea that essentially any economy in the world will follow three types of exchange rate systems. One of the three, obviously, not three at the same time, but one of the three types of exchange rate systems. So there are three main types of exchange rate systems that any economy can obviously implement. The first is floating exchange rate. The second is fixed exchange rate. The third is managed float exchange rate. Right? The floating exchange rate system will be explained in a lot of detail in today's lesson, in which we'll discuss number one, what is a floating exchange rate system, how is it determined, then what are the factors that cause a change in the floating exchange rate system, right? And we'll obviously go through some of the diagrams that are related to the floating exchange rate system as well. So let's start with the floating exchange rate system. What is a floating exchange rate system? The first thing, by the way, a floating exchange rate system is also known as a free float system. So, what is meant by a floating exchange rate system? So, a free floating system of exchange rate determination is when a country's exchange rate is determined by the market forces of demand and supply without any government intervention. There is no government intervention, and exchange rate is determined by the forces of demand and supply of the currency in the foreign exchange market. Right? And that exchange rate is obviously determined as the equilibrium exchange rate, where the demand for the local currency and the supply of the local currency are equal. That is where the exchange rate of a country is determined. Right? And we know for a fact that the demand for any currency is a downward sloping curve, because exchange rate, which is the price of the currency, and the quantity demanded of the currency are negatively or inversely related, because when exchange rate falls, the currency becomes cheaper, so people would tend to buy more of the currency, and vice versa. While the supply of the currency is an upward sloping curve. I've actually drawn this here. So the supply of the currency is an upward sloping curve. Why? Because of the positive relationship between exchange rate and the supply of the local currency, right? Why is there a positive relationship between the exchange rate and the quantity supplied of the local currency? Because as the price of the currency rises, the quantity supplied of the currency rises, because obviously there is a greater incentive for the suppliers of the local currency to keep on supplying the local currency, right? And that is the reason why supply curve is an upward sloping curve, right? So this is very straightforward. Now, what are the factors that determine the demand and supply of the local of any currency for that matter? So there are three factors that determine the demand for the currency, and there are three factors that determine the supply of the currency. And by the way, these are non-price factors, or in better terms, non-exchange rate factors. So essentially, these are factors that cause a shift in the demand and the supply of any currency. What are those factors? Number one is, let's actually first talk about factors that cause a shift in the demand for the currency. The first factor is the demand for exports. When the demand for exports increase, that means people want to buy, or foreign people living in foreign countries want to buy our local product. But for that, in order to buy our local product, they first have to buy our own currency, our local currency. So when the demand for our exports rises, that means the demand for the local currency will increase, because obviously foreign people need to buy our currency first in order to buy our goods, right? And that will cause a rightward shift in the demand for the local currency. Right? This is number one. Number two, investment prospects in the local country increase. Right? So when there is an increase, or when there is an increase in the investment prospect of the local country, meaning that investment in our country has become more lucrative for foreign investors. If they invest in Pakistan, they'll get higher profits, right? So when investment prospects are high in the local country, that means foreigners will tend to invest in our country as well. And when foreigners invest in our country, they have to invest in our currency, because when they bring their investment in Pakistan, they will have to obviously invest in rupee terms, right? And for that, they need to buy the rupees in order to invest in Pakistan. So they need to buy rupees to invest in Pakistan, and that results in an increase in the demand for rupee or the local currency. So increase in investment prospects in the local country means that there will be more investment by foreigners, which will lead to an increase in the demand for the local currency, because those living in foreign countries will be investing in Pakistan, and obviously they'll be investing through through rupees, and they'll obviously first have to buy the rupees, right? Number 3, savings from abroad in our local country. Let's suppose people living in foreign countries want to save money in our banks and in our bonds, right? So people living abroad want to save money in our banks and our bonds. In which currency will they save money? They'll obviously save money in Pakistani rupees, right? So if the demand for savings in local banks has increased, that means they'll first have to buy our currency in order to save in our banks, which means the demand for the local currency will rise. This is the third factor. And then there is another factor, positive speculation. First, what is meant by speculation? Speculation is when you expect the value of something to rise, so you buy that asset today in order to sell it at a higher price in the future. So let's suppose you expect the value of the rupee to rise in the future. What will you do? You'll start to buy the currency, you'll start to buy rupees today, right? Positive speculation means that people want to buy more rupee because they obviously sell it when the price of rupee increases at a profit, right? So positive speculation is we're expecting the price of rupee or the exchange rate of rupee to rise. As a result, we increase the demand for the local currency. We want to buy the local currency so that obviously when the price reaches its peak, we can sell it. So the demand for the local currency rises. These are factors that cause a shift in the demand for the local currency. Now, what are the factors that cause the supply of the local currency to shift? Opposite factors. If the demand for our exports leads to an increase in the demand for the local currency, that means an increase in the demand for imports will lead to an increase in the supply of the local currency. Why? Remember, supply of the local currency increases when we want to buy foreign currency. So let's suppose if we want to buy dollars, if the demand for the dollar has increased, and obviously we have rupees, that means we want to buy more dollars, right? How will we buy more dollars? By selling our rupee. And selling of our rupee means what? Increase in the supply of rupee, right? And obviously we want to buy dollars because we want to import goods from the US. The demand for our imports has increased. We want to buy goods from the US. So what would we do? We would want to buy dollars, and for that we need to sell our rupees. That means the supply of rupee increases. So when the demand for imports increases, that leads to an increase in the supply of the local currency because we want to buy the foreign currency. Number one. Number two, if investment prospects in foreign countries, for example, Dubai, investment prospects in Dubai have risen. Pakistanis want to invest in Dubai. What will they do? They would obviously buy their the UAE currency, right? And in turn or in return, they'll sell the rupee, which would mean there will be an increase in the supply of the local currency. Rightward shift in the supply curve for rupee. Number 3, if the locals want to save money in foreign countries, let's suppose the local people want to save more money in Swiss banks, what will they do? They will sell the rupee in order to buy Swiss francs. So as a result, the supply of the rupee will increase. And number 4, negative speculation. Negative speculation is we're expecting the price of an asset to fall. So before the price of that asset falls or falls considerably, we tend to sell it. So if we expect the price of rupee will fall in the future, we'll sell the rupee instantly. Right? Which means negative speculation means we will increase the supply of the local currency because we expect the value of this currency to fall in the near future. Right? So the supply of the local currency will rise. These are the factors that cause a shift in the demand and supply of the local currency. Right? Now, remember, when we talk about a free float exchange rate, there are two types of movement. There are two types of movements that can that can result in the free float exchange rate. The first type of movement is known as appreciation. Right? Appreciation is when the currency becomes expensive or when the exchange rate increases in a floating exchange rate system. Right? So in a floating exchange rate system, when the value of the currency increases or when exchange rate increases or when the currency becomes expensive, any of these explanations is good. So when the currency becomes expensive in a floating exchange rate system, there is an appreciation of that currency. Right? I've written an example. So for example, in 2010, $1 was equals to 150 rupees. In 2011, that $1 is equals to 160 rupees. That means now $1 can purchase more rupees. Or you need to have more rupees to buy $1, which means the dollar has become expensive. Initially, it was just 150 rupees worth for $1. Now the price of $1 is 160 rupees. That means the dollar is becoming expensive, which means if this is obviously happening in a free floating exchange rate, that means the dollar is appreciating. When does this happen? This happens when either the demand for the currency rises or the supply of the currency falls, as you can see in this diagram. Let's suppose the initial demand and supply curves were these, and the initial exchange rate was ER1. When the demand for the currency increased and the supply of the currency fell, which means the new demand and supply curves are these, this and this, this and this. So they're intersecting here, which means the new exchange rate is this one, and as you can see, the currency has become expensive. This is appreciation of the currency. By the way, when does a currency appreciate? We'll talk about that in a couple of minutes. Right? The causes of appreciation and depreciation, they're coming in a couple of minutes. Now, what about depreciation? The second type of movement in a country's exchange rate, assuming the country is following a floating exchange rate system, is known as depreciation. Depreciation is when a free floating exchange rate becomes cheaper or when the value of the exchange rate falls. That means the value of the currency has depreciated when it becomes cheaper in a free floating exchange rate system. Right? An example here is, in this example, the dollar was appreciating and hence the rupee is depreciating. Or let's suppose I've used an example here. $1 was initially equal to 0.8 pounds. Now $1 is equals to 0.7 pounds. That means we need lesser pounds to buy that $1, which means here the dollar is depreciating. The dollar is becoming cheaper. Right? So the dollar is depreciating in a free floating exchange rate. When does this happen? This happens when the demand for the currency falls or when the supply of the currency rises. Again, as you can see in this diagram, D1, S1 is the old demand and supply curves, and exchange rate is ER1 is the old exchange rate. So when the demand for the currency falls, or when the demand for the current, or when the supply of the currency rises, the new equilibrium is here when D2 and S2 are meeting. And as you can see, this is at a lower value, so the exchange rate has fallen, which means if the exchange rate has fallen due to a free floating exchange rate without any government intervention, that means the currency's value is depreciating. Right? This is what a floating exchange rate or what the two types of movements in a floating exchange rate look like. Right? Now, the next question is, what are the causes of appreciation and depreciation? Right? I've written a lot of detail here in these paragraphs, and then I've made these summary sort of chains of analysis that explain the causes of depreciation and obviously appreciation. Let's go through the causes of depreciation because the causes of appreciation are complete opposites. Right? So let's actually go through the causes of depreciation in a lot of detail. We know for a fact, we've just discussed, that depreciation occurs when there is a fall in the demand for the currency or a rise in the supply of the currency, or both. The question is, when does the demand for the currency fall, when does the supply of the currency rise? Let's talk about these factors that cause these changes in demand and supply. The first cause of exchange rate depreciation is when the domestic interest rate is less than the foreign interest rate. So let's suppose interest rate in Pakistan falls. When interest rate in Pakistan falls, and maybe it's less than the interest rate in Dubai, what happens? Local people want to save, or actually, I've actually written that savings in local banks decrease. So the first, this green highlighted point is that foreigners want to save less in Pakistani banks. So let's suppose Pakistan's interest rate has fallen. That means foreigners would tend to save less in Pakistani banks because the return on Pakistani bonds or saving schemes has fallen. So foreigners would tend to save less in Pakistani banks. While maybe because foreign interest rates are higher, the locals would want to save more in foreign banks. They would want to save more maybe in Dubai banks or in Swiss banks, etc. Right? This means when the foreigners save less in local banks, as a result, the demand for our currency falls. And when we want to save more in foreign banks, that means we would want to sell more of our currency, which means the supply of the local currency rises. As the demand for the local currency falls, the supply of the local currency rises. As you can see in this diagram, the supply is rising, the demand is falling, the exchange rate is depreciating. This is the first point. The second point is, if domestic inflation is greater than foreign inflation, if let's suppose inflation rates in Pakistan are higher than most of our trading partners, that means the demand for our exports will fall, and we would want to import more goods from abroad because we believe they are cheaper goods. So the demand for imports will fall, the demand for imports will rise because our inflation is higher. When the demand for our exports falls, that means the demand for the local currency falls. When the demand for our imports increases, that means the supply of the local currency increases. Remember, the demand for exports affects the demand for the local currency, and the demand for imports affects the supply of the local currency. When the demand for the local currency falls, supply of the local currency rises, the exchange rate depreciates. Number 3, when the domestic investment prospects are really bad compared to foreign investment prospects. As a result, foreigners will invest less in Pakistan and locals would want to invest more in other countries. As a result, because foreigners want to invest less in Pakistan, they will demand less of our currency. We want to invest more in foreign countries. That means we would want to sell our currencies. The supply of the currency rises. As a result, the exchange rate depreciates. Number 5, negative speculation. Meaning, we expect the value of our currency to fall in the near future. Or we expect the value of the other currency to rise in the near future. What will we do? We will start to sell our currency for the other currency. Selling means the supply of the local currency will rise. As a result, exchange rate will depreciate. Number 5, economic growth in our local country. If there is a high economic growth in the local country, that's good, obviously. But that will cause an exchange rate depreciation of the local currency. Why? Because when there is economic growth in the local country, two things happen. Number 1, economic growth causes people to spend more on foreign goods because the local people are richer. They would want to spend more on foreign goods because they can afford to spend more on foreign goods. And as a result, the demand for imports will increase. Number 2, economic growth also means more production of goods and services in the local country, which means more demand for raw materials and more demand for capital goods, which may be imported from abroad. Both mean that there will be an increase in the demand for imports as a result of economic growth, which means the supply of the local currency will rise, which will cause exchange rate to depreciate. Right? And number 6, a recession in trading partners. What if there is a recession in China? That means their incomes are falling. That means their purchasing power has fallen. That means they would want to, and they have to now buy less goods and services from Pakistan because maybe they cannot afford to buy a lot of goods from Pakistan. They always remember when your ability to buy or your incomes fall, there is a big impact on your ability to import. So imports fall. Right? So China's imports will fall. As a result, Pakistan's exports will fall. When Pakistan's export fall, export affects demand for the local currency. The demand for the local currency will fall. As a result, the exchange rate will depreciate. These are causes of exchange rate depreciation. All of these causes, if inversed, for example, if we write this, if we write this, if we write this, right? If we write positive speculation, if we write economic growth in foreign country, and if we write recession in local country, right? Everything will reverse. The demand for the local currency will increase. The supply of the local currency will decrease. That will lead to an exchange rate appreciation, and that is explained in the next page. And obviously in a lot of detail in these tables that I've included in my notes. With that, we are done with exchange rate depreciation and appreciation. So we've basically done three main things. Number 1, we've covered what is floating exchange rate system. Number 2, we've covered what are the factors that cause obviously changes in exchange rate system, and what are those what are those changes in exchange rate systems what are those changes in the exchange rate system called, i.e. Depreciation and appreciation in the floating exchange rate system. And number 3, what are the causes of appreciation and depreciation. In the next lesson, inshallah, we'll be able to cover the same things for fixed exchange rate system. And then a very important concept is what are the consequences of an increase or decrease in exchange rates, whether that is talking about floating exchange rate system or fixed exchange rate system. Inshallah, that is also something that we'll discuss in the next few classes, inshallah. Right? So with that, we'll call it a day. Assalamu alaikum.